Hello, welcome to another edition of Banking News and Views, wherein we take a look at the development in the banking sector during the week ended 17th May 2020. I am Srinivasan. COVID-19 pandemic has thrust the banking sector onto the forefront since it is only the banking and the shadow banking sector which can pull out the economy from the likely morass which it may soon encounter. So let's quickly see what was the news for the last week. Banks look to float AMC, that is the asset management company, to deal with bad loans. MSME, that is micro, small, medium enterprises, needs separate rating system to boost credit, says Raj Kiran Rai, CEO of Union Bank of India. Senior citizen depositors of PMC Bank moved the Delhi High Court. RBI to revisit external commercial borrowings framework. Government may issue sovereign perpetuity bonds to finance fiscal deficit. India ionics commences offshore derivatives trading in the gift city. World Bank to lend US dollars 1 billion to support India's COVID fight. Loan loss provisioning of PSBs, that is public sector banks, are more pro-cyclical compared to private sector banks, says RBI study. So let's get into details of these news. So banks look to float AMC to deal with bad loans. A recent report by CRISIL titled as Viral Fever COVID-19 Impact on Economy, Corporate Revenue and Profitability has estimated that banks' gross non-performing asset, that is the GNPAs, is likely to rise by 150 to 200 basis points in fiscal 21. That is, it is likely to rise from 9.5% in fiscal 20 to 11 to 11.5% in fiscal 21. And this is due to higher slippage and lower recovery. The pandemic led economic slowdown should also result in higher incremental slippages in the current fiscal as well. And this is estimated at 3.9% of the net advances. So, about 2 years ago, July 2018 to be exact, the Sunil Mehta Committee had submitted a report to the then Finance Minister Piyush Goyal pitching for AMC, that is Asset Management Company, and AIF, that is Alternative Investment Funds, led resolution approach for stressed loans above 500 crore. Sunil Mehta was then the non-executive chairman of Punjab National Bank. Now, with the banks expecting slippages, the IBA has taken up this recommendation of Sunil Mehta committee report and has been sounding off the RBI and the finance ministry about this proposal. So the big question are two things, because according to CII, the industry body, banks would require an allocation of almost 2 lakh crore for its recapitalization to meet credit needs. Having said that, the question is, would such a framework deliver results? Perhaps yes, and perhaps no. We do have ARCs, that is Asset Reconstruction Company, Sarfasi Act, to help the bank to recover their money. So on paper, it looks good, but it has not even touched the tip of the iceberg in terms of redressal. So, would another AMC taking over the stressed assets work? Yeah, maybe yes. Since this is going to be an omnibus AMC, which will work across the banks, and prospective buyers of stressed assets need to go to one single agency, unlike the plight of ARCs who go fishing to every bank looking for taking over of stressed assets. So let's see whether RBI will be inclined to consider this proposal. And if yes, it could be quite some time before it is established. The other important news is the MSME needs a separate rating system to boost credit, so says Raj Kiran Rai, CEO of Union Bank of India. He couldn't have been more right. The MSME sector, which is already reeling due to lack of capital and supply side issues, has further been hit hard on the demand side by the lockdown due to COVID-19 pandemic. And with banks being increasingly risk averse, funding towards MSME is or was always a question, which is why the finance minister has rolled out so many measures, specially skewed towards MSMEs. While there has been some initial discussion with CBIL on developing a separate framework for rating MSMEs, nothing much has progressed so far. Now, according to MSME's ministry, that is FY19 annual report, the MSME sector is dominated by micro enterprises, and India has got 6.33 crore MSMEs, out of which 6.30 crores, that is almost 99.4%, are micro enterprises, and 0.52, which is about 3.31 lakh, are small, and 0.007%, hardly anything, that is about 5,000, are medium enterprises. This sector is labor intensive as well, so it makes eminent sense to devise a mechanism to rate these units so that there is a standard methodology through which credit flows into this sector. Now, as on date, to boost credit flow to MSMEs, it's also necessary for us to lower the rate of interest, lower the rate at which banks lend to this sector. And there is also a need to have an interest rate subvention scheme. Well, let's hope it happens. Credit rating, as is done for the corporates, which assesses the credit worthiness of an entity, would definitely boost the credit deployment to this sector. Senior citizens depositors of PMC Bank move Delhi High Court. Senior citizen depositors of scam hit Punjab and Maharashtra Cooperative Bank have moved the Delhi High Court, asking that they be allowed to withdraw more money from their deposits as they face great hardships amid the pandemic. The Mumbai based cooperative bank, the PMC Bank, whose financial position deteriorated drastically due to alleged fraud and financial irregularities and manipulation of books of accounts, was placed under RBI's all inclusive directions with effect from the close of business on September 23rd, 2019. Following which, the deposit withdrawal was also capped. Many senior citizen depositors of PMC Bank are totally dependent on the interest on their deposits. So, what RBI did was RBI enhanced the limit for withdrawal from 1,000, that is on September 24, 2019, 250,000, that was on November 5th, of the total balance in their account in four stages. Now, RBI also issued a circular dated April 30th, 2020, which enhanced the maximum withdrawal limit for medical expenses for critical life threatening ailments to 5 lakhs of rupees from 1 lakh of rupees. As I told you, India in any case does not have any old age social security scheme. So many senior citizens depositors of PMC Bank are totally dependent on interest on their deposit. Every citizen has to fend for himself during his old age. They are not able to meet their non-critical medical expenses. Prices of essential commodities have also increased in wake of COVID-19 pandemic. They are also not able to meet their day-to-day expenses. And there is also another point that needs to be mentioned. The government was very quick to move in Yes Bank's case, pumping almost 10,000 crores, roping in SBI and a host of other investors. Why Punjab and Maharashtra Cooperative Bank has been given a stepmotherly treatment is something which markets cannot fathom. For RBI to revisit external commercial borrowings, they're going to revisit the entire framework. So let's understand what is RBI looking at. ECBs, as you all very well know, are commercial loans raised by eligible resident entities from recognized non-resident entities. Now, the Reserve Bank of India may revisit its external commercial borrowing framework, relaxing the parameters. These parameters are all-in cost ceiling, tenor, end of use of funds, to enable lower rated Indian corporates tap this funding route in the backdrop of domestic banks turning risk averse. The interesting thing is that, as opposed to our credit markets, where the liquidity dries up beyond AAA rated companies, Indian bond market, that is, Indian foreign issues, do attract a lot of investors, which means while foreign investors have an appetite for Indian debt, the ceiling, the AIC ceiling, that is the all inclusive cost ceiling, needs to move higher to reflect new credit risk and operating environment so that companies which are rated, say, AA or AA plus, can also access the foreign market. Now, Barclays Bank came across a very interesting trend. It found that investment grade rated corporates were looking at buybacks of some of their dollar denominated bonds, especially the near term maturities, which was trading much wider than where the bank financing is available. Many investment grade rating companies continue to have liquidity in their balance sheet and are also attracting funding from the banks. So it's time that the lower rated corporates also get an opportunity to tap the global funds, since currently global markets are awash with liquidity. Government may issue sovereign perpetuity bonds to finance fiscal deficit, so says the SBI EcoWrap report. If you recollect, in my earlier news capsule, I had said that the government plans to borrow higher than the budgeted amount, and it is likely to be in the range of 12 lakh crores. So the borrowing by the government this year would be higher by around 4 to 4.5 lakh crores due to shortfall on account of disinvestment and also shortfall due to tax and non-tax revenues. The government can resort to various options, including sovereign perpetuity bonds, zero coupon bonds, and tax free bonds. Monetization of the fiscal deposit could also be done through issuing of newly created money and transferring it to the government. Sovereign perpetuity bonds have been used by US and UK for a sorry. Sovereign perpetuity bonds have been used by UK and US in the 18th and the 19th century to finance war mobilization. But long term government bonds going up to even 100 years are common enough. In fact, the Austrian government issued 100-year bond just last year. India ionics commences offshore derivative trading in the gift city, Ahmedabad, Gujarat. On May 8th, BSE's India International Exchange Limited, that is India INX, launched its offshore currency derivative trading through International Financial Services Center at the gift city, Gandhinagar, Gujarat. This is truly a proud moment for us. So, trading on INR USD futures and options would enable participants to hedge, trade, and settle in US dollars since this is an offshore market. With government rules and ecosystem at GIFT IFSC on par with other global markets. Otherwise, you would have to go to either the Singapore market, Singapore offshore market, or Dubai offshore market. With the launch of INR USD derivative, the trades that have been migrated to other international financial centers such as SGX, that is Singapore market, DGCX, that is the Dubai market, will now bring rupee trading back home. Currently, contract is available for 12 monthly and 11 weekly contracts for both USD INR spot rates and INR USD spot rates. So, what would be the impact on the long run on our INR dollar spot rate? The offshore NDF market, that is the non deliverable forwards, is a speculative market. And only now banks were permitted to trade. Now, this NDF market will not be able to dictate the exchange rate of rupee here in the onshore market. Secondly, huge amount of positions on rupee could be taken here at our IFSC offshore center for dealing in currency derivatives, and that could be the true benchmark of Indian rupee versus dollar, and this could impart a certain level of stability in our exchange market. So I would say that the US dollar, India US dollar rate of exchange would get stabilized, and the NDF market would not be able to substantially influence as it did earlier. Now, this would, of course, be in the long run. Now, World Bank to lend 1 billion US dollars to support India's COVID fight. Last Friday, the World Bank announced $1 billion loan for India to support its COVID social protection response program. Now, this new support will be funded in two phases: an immediate allocation of $750 million for the fiscal year 2020, Now, fiscal means July 1st, 2019 to June 30th, 2020. And 250 million, that is the second tranche, that will be made available for the fiscal year 2021, which starts from July 1st, 2020 to June 30th, 2021. With the latest tranche, the total commitment from the bank towards emergency COVID-19 response in India stands at $2 billion. A $1 billion support was announced last month towards immediate assistance to India's health sector. The first phase of operation will be implemented countrywide through Pradhan Mantri Garib Kalyan Yojana, or what is called as PMGKY. Loan loss provisioning of public sector banks are more pro-cyclical compared to private sector banks, says an RBI study. Pro-cyclical provisioning, a pretty important word, which actually refers to building up of or creating a provision for bad and doubtful debts, or creating provision for loan loss provisions when the business cycles turn and the economic conditions deteriorate, while reducing the same in good times, when actually it should be the other way around. Loan loss provisioning by the public sector bank is more pro-cyclical compared to the private sector banks, according to this RBI study. Now, we are pretty certain that the implementation of Indian accounting standards, which requires bank to make provisions for expected credit losses from the time a loan is originated, rather than awaiting for trigger events signaling imminent losses, is definitely expected to help address this issue. So, with this, our news for this current week closes. See you all next week with an additional installment of banking news and views. Till then, stay safe, stay positive, take care. Bye bye. See you next week.